One of the most fundamental concepts of investing is the relationship between return and risk, or risk versus reward. And so when you are first taught this concept, there's basically a positive relationship between risk and return, meaning the more risk you take, the more return you can make. But of course, the key word in that sentence is can, because return is never guaranteed. And so when we talk about greater return with the greater risk, there's also the greater dispersion of outcomes that could occur, which actually could result in less favorable outcomes and even loss with the greater risk that you take. Now, this isn't the most complicated topics, but it is very foundational, very fundamental, and somebody like Howard Marks has really built a career talking about the relationship between risk and reward. So as an investor, it's really important, whether you're an LP or a GP, to understand this concept as you're doing deals and thinking about, okay, what are the risks of the deal I'm doing? And based on the risk factors of this deal, what is the appropriate return that I should be targeting? Because there's no one size fits all. It's not like every good deal out there is a 15% return, right? There's one deal out there that is a great deal at a 15% return, and there are other deals out there that at the same 15% return is a bad deal. It's just, what's the difference? The location is worse. The tenant concentration or the risk profile or the business plan itself, the market is growing or declining. And so those factors contribute to whether or not the predicted return is actually a good one for that deal or not. So as I mentioned, while this is very foundational, it is pretty well understood and well known out there. Obviously, harder to remember all the time when you're in the middle of the market and things are moving quickly. But the real thing I want to talk about today is this same concept of reward versus risk as it relates to actually being a fund manager and raising capital. Because we're seeing right now fund managers grow in popularity, and so people are looking at deals that they could raise capital for, and they're thinking, what's in it for me? Which obviously we're all obviously selfish creatures, and we're thinking what's in it for us. But as a fund manager, you are being compensated for raising capital, but you're being compensated in equity in the deal. And so what matters is not just what the projections say as far as how much money you're going to make. It also matters if the projections are actually going to turn out to be true. And obviously the greater risk of the deal, yeah, the projected returns might look better, and therefore your compensation as a fund manager might look better, but there's also a greater risk that your compensation actually ends up being zero. So what's important is, as a fund manager, you really need to think about the deal as an investor, right? You're not just a broker pitching a deal and slamming a deal together and moving on. You're living and breathing this deal, and you're investing in this deal. Because even if you're not investing any of your personal money as a fund manager, you're investing your sweat equity, because it's taking a lot of time and effort to vet the deal, to raise money from your investors. And let's not forget about all the years of effort that it took you to build those relationships and to build the trust with your investors to get them to invest in this deal. So you've got a ton of sweat equity. And then also, similar to that, you have relational equity, where you're actually spending your relationship equity on this deal from your investors, right? Because like I mentioned, not only is your projected compensation at risk, depending on how the deal performs, your reputation is at risk, depending on how the deal performs. So I think this makes it twice as important as a fund manager to ensure that what you're investing in is not just benefiting, your projected pocketbook because it's projected to make you 15% on the money that you're raising. It's about, what is this going to do for my relationship and my reputation with my investors for the next year, 5 years, 10 years? And what's the eventual outcome of the deal going to be? And therefore, what's my real deal actual compensation going to look like when the deal goes full cycle and I get a piece of the promote, or I earn my promote through the double waterfall structure as the fund manager? So this is my big message for this video. Just want to put it out there for fund managers to really put your investor hat on and think about the deals that you're raising capital for, not just vetting them out as, oh, is this a good deal for my LPs and how much money do I make? But really think, if you were investing your own money into the deal, how would you really think about the deal? Because that's what your projected compensation really is. It's an investment, and if the deal goes well, your compensation will work out. And if the deal doesn't go well, you're not only going to lose out on the compensation, you're also going to damage your relationship equity and impair that. So it's kind of an often said statement in our business, it's true for me, and I think it's true for many in our business. I and many others would much rather lose our own personal capital than someone else's money. And so that's how you should think 10 times over as a fund manager when thinking about investing in your next deal and partnering with your next sponsor.